A finished development sits empty on the Florida coast. The access roads curve smoothly through landscaped entrances. Gate mechanisms cycle on timers, opening to no one. Automated irrigation systems activate at dawn, watering grass that no residents walk across. The lobby lighting responds to motion sensors, illuminating marble floors for maintenance crews who arrive twice weekly. In the fitness center, equipment gleams under scheduled LED cycles. The rooftop pool's filtration system runs continuously, maintaining chemical balance in water no one swims in. Nothing is broken. Nothing is delayed. Construction completed on schedule, 18 months ago. Every unit received its certificate of occupancy. Every system passed inspection. The development stands ready. It simply assumed one number would hold. If an entire billion-dollar project depended on one assumption being correct, what happens when it isn't? This development wasn't built on optimism. It was built on certainty. The proposal that reached the investment committee in 2016 came with 247 pages of financial modeling, market analyses from 3 independent firms, demographic projections, comparable sales data spanning 8 years, construction cost estimates verified by quantity surveyors, operating expense forecasts built from actual performance data at similar properties. The developers were experienced. Their previous projects had delivered returns within 3% of projections. They understood permitting timelines, construction risks, and market cycles. They had survived the 2008 collapse and adapted. This was not their first luxury tower. The site was exceptional. Oceanfront land in an established neighborhood where new development was increasingly restricted. Zoning was already in place. Neighboring properties were selling for record prices. The location had appreciated steadily for 15 years. The design came from an architecture firm known for sellable luxury. Floor plans optimized for the target demographic. Amenities selected based on focus group research. Finishes calibrated to market expectations at this price point. Everything was tested against buyer preference data. The construction plan was conservative. A reputable general contractor with a fixed-price contract. Contingency funds built into every line item. Timeline padding for weather delays and permitting. The project would take 32 months from groundbreaking to final certificate of occupancy. The schedule assumed problems. The financial structure was standard for projects at this scale. The developers would contribute equity. A construction loan from a national lender would cover the majority of hard costs. Pre-sales during construction would pay down debt before completion. Remaining units would sell after completion, generating profit once debt was retired. Every piece was conventional. The model had been used successfully on dozens of comparable projects across Florida. This was not experimental development. This was replication of a proven formula in a proven location. The investment committee spent 6 weeks reviewing the proposal. They hired outside consultants to verify the numbers. Legal counsel examined the site control agreements and construction contracts. The lender's credit team conducted their own underwriting. Multiple sets of eyes, all asking the same questions. Where could this fail? What are the risks? The answers came back reassuring. Site risks were minimal. The land was controlled and zoned. Construction risks were standard and priced into the budget. Permitting risks were low. The municipality was development-friendly. The contractor had completed similar projects without significant cost overruns. The market risk received the most scrutiny. But here, the data was compelling. Luxury condominiums in this submarket had sold consistently for the past decade. Inventory was tight. New supply was constrained by zoning and land availability. Population growth in the region was strong. The target demographic, affluent retirees and second-home buyers, had wealth insulated from economic cycles. In November 2016, the investment committee approved the project. Capital commitments totaled $180 million in equity and debt. Construction began in January 2017. No one thought they were gambling. The numbers worked. The market was there. The execution risk was manageable. Every assumption had been tested. Every variable had been stress tested. The confidence was institutional, not individual. This wasn't one developer's hunch. It was the consensus of analysts, lenders, consultants, and attorneys, professionals whose careers depended on not making catastrophic mistakes. The certainty came from the data, and the data at that moment all pointed in the same direction. This wasn't one person's idea. It passed every institutional filter. The development team consisted of 4 principals: average age 52, combined experience exceeding 90, years in real estate development. None were newcomers. All had survived market cycles. Their previous projects had produced cumulative returns exceeding $400 million for investors. The equity came from 3 sources. The principals contributed $12 million from personal funds and previous project distributions. A real estate private equity fund committed $48 million. A family office representing wealth from pharmaceutical distribution added $20 million. Combined equity totaled $80 million. Each equity source conducted independent due diligence. The private equity fund employed a team of 6 analysts who spent 3 months modeling the project. They built sensitivity analyses testing different absorption rates, pricing levels, and cost scenarios. They visited comparable developments. They interviewed brokers. They reviewed every contract. The family office hired a third-party advisory firm to evaluate the investment. That firm spent 8 weeks examining the business plan, questioning assumptions, and stress-testing outcomes. Their report ran to 127 pages. It identified risks, it recommended modifications to the waterfall structure, but it concluded the project was fundamentally sound. The construction lender was a regional bank with $8 billion in assets. Their real estate lending group had originated over $2 billion in construction loans across the Southeast. They did not lend casually. Their underwriting process took 4 months. The bank's credit committee required 12 separate items before approval: independent appraisal, environmental assessment, geotechnical report, title review, survey, construction budget verification, market study, borrower financial statements, personal guarantees, pre-sale requirements, completion guarantees, and legal opinions on entity structure. The appraisal came from a MAI-designated firm with no relationship to the developers. They reviewed 50 comparable sales, interviewed 10 brokers, analyzed absorption rates over 5 years, and applied 3 valuation methodologies. Their concluded value for the finished project was $285 million, against total project costs of $260 million. That provided a 9.6% margin. The market study was conducted by a different firm specializing in luxury residential analysis. They surveyed 100 potential buyers. They analyzed demographic trends. They documented competitive supply. Their conclusion: demand would absorb all units within 18 months of completion at projected pricing. The credit committee met twice. Questions were extensive. Why this location? How confident are the pricing assumptions? What if absorption takes longer? What if construction costs overrun? What about market risk? Each question received detailed answers backed by data. The location was proven. Neighboring properties were selling above $1,000 per square foot. Pricing assumptions were conservative relative to recent sales. The project assumed $950 per square foot. Absorption was modeled at multiple rates. Even at half the projected pace, returns remained acceptable. Construction costs included 15% contingency. Market risk was mitigated by the tight supply environment and favorable demographics. The credit committee approved a $100 million construction loan in September 2016. The approval memo stated, The project reflects moderate risk commensurate with the asset class. The sponsors are experienced, the location is strong, market fundamentals support the business plan. Beyond the primary capital sources, others validated the plan. The general contractor reviewed the budget and confirmed it was realistic. The architect verified that the design could be built within cost parameters. The civil engineer certified that site work was straightforward. The sales and marketing firm hired to handle pre-sales reviewed the pricing strategy and called it achievable. No single gatekeeper could have blocked this project. The approval structure was diffuse. Capital came from multiple sophisticated sources, each with independent analysis. Professional service providers, appraisers, market consultants, attorneys added layers of verification. The system was designed precisely to prevent one person's error from becoming everyone's problem. No individual assumption went unchallenged. Every input was questioned, and yet the system reached consensus. The project made sense, the numbers worked, the risk was acceptable. That consensus was not manufactured or coerced. It emerged organically from institutional processes designed to identify flawed assumptions before capital was committed. Committees met, analysts modeled, consultants opined. Everyone concluded the same thing. The assumption at the center of the project wasn't hidden or ignored. It was examined extensively. It was the most scrutinized element of the entire plan, and everyone agreed it would hold. The numbers worked as long as one thing stayed true. The entire financial model rested on a pricing assumption. Completed units would sell for an average of $950 per square foot, not $100 or $200 per square foot, which some comparable recent sales had achieved, not $850, which would have provided more margin. The assumption was 950, a number derived from careful analysis of market data. The project totaled 180 units across 275,000 sellable square feet. At $950 per square foot, total sellable value was $261 million. Against all-in project costs of $260 million, land, hard costs, soft costs, financing, carrying costs, that left $1 million of nominal profit before considering the pre-sales that would occur during construction. The model assumed 30% of units would pre-sell during the construction period at a 5% discount to post-completion pricing. That meant 54 units selling at $902.50 per square foot. The revenue from pre-sales would pay down construction debt before completion, reducing carrying costs and improving returns. The remaining 126 units would sell after completion at the full $950 per square foot. The absorption model assumed 18 units per month, moderate compared to historic performance at comparable buildings where absorption had reached 25 units per month. At 18 units per month, the building would sell out 7 months after completion. That pricing assumption, $950 per square foot, was the keystone. Remove it, and the entire structure shifted. If units sold at $900 per square foot instead, total revenue dropped by $13.75 million. That eliminated profit and created a $12.75 million loss before equity. If pricing fell to $850 per square foot, the loss expanded to $27.5 million. At $800 per square foot, the loss reached $41.25 million, consuming more than half the equity. The assumption wasn't arbitrary. It came from market evidence. In the 12 months before project approval, 17 units in comparable buildings within 3 miles had sold for an average of $967 per square foot. The range was $890 to $1,140. The median was $945. The $950 assumption was essentially the median, not aggressive, not conservative, simply reflective of recent performance. The market study drilled deeper. It separated the sales by unit size, view, and floor level. It adjusted for differences in finishes and amenities. It controlled for timing. Sales from spring sold at a premium to sales from fall. After adjustments, the study concluded that this project's units should command $940 to $980 per square foot, depending on position in the building. The appraisal reached similar conclusions through different methodology. It analyzed price per square foot trends over 5 years. It examined absorption rates and inventory levels. It interviewed brokers for qualitative input on buyer behavior. The appraisal's indicated value implied $970 per square foot, higher than the project's assumption. Every analysis pointed the same direction. 950s was reasonable, perhaps even conservative. But the assumption wasn't just about current pricing, it was about future pricing. The project would take 32 months to build. Units wouldn't deliver until mid-2019. The question wasn't what units sold for in 2016. The question was what they would sell for in 2019 and 2020. That required assumptions about market trajectory. Would prices remain stable? Would they appreciate? Could they decline? The market study projected 3% annual appreciation based on historic trends. That meant by mid-2019, comparable units should be selling for $1,027 per square foot. The $950 assumption built in a 7.5% discount to that projection, a margin of safety. Even if prices remained flat from 2016 to 2019, the $950 assumption would be conservative relative to current sales. Prices would have to decline roughly 2% from current levels for the assumption to prove optimistic. The probability of a 2% price decline seemed remote in 2016. The market had been rising for 7 consecutive years. Inventory was tight. Demand was strong. The economic backdrop was favorable. Low unemployment, rising wages, strong stock market performance, low interest rates. More fundamentally, luxury real estate in this market had proven resilient. During the 2008-2010 downturn, pricing in this specific submarket had declined only 11% peak to trough, and recovered fully within 4 years. Even in the worst housing crisis in generations, this location had held value better than almost any other market in the country. The assumption felt safe because it was grounded in data, supported by multiple analyses, and conservative relative to projections. It wasn't a hope, it was a conclusion drawn from evidence. And that evidence, in 2016, was unambiguous. Nothing about it appeared risky at the time. The market for luxury condominiums in this corridor had grown steadily since 2011. After bottoming in 2010 following the financial crisis, prices had climbed every year. By 2016, pricing had exceeded the previous, 2006 peak. The recovery had been consistent, not volatile, annual appreciation averaging 6% to 8%, not the unsustainable spikes that characterized the mid-2000s bubble. Supply and demand fundamentals supported the trend. On the supply side, new development was constrained. Zoning in the municipality limited building heights and densities. Available land was scarce. Environmental regulations restricted coastal construction. Permitting timelines had lengthened. The result? Very few new projects were being delivered. Inventory data confirmed the constraint. Across the relevant submarket, only 220 units were under construction in projects comparable to this development. Historic delivery averaged 400 units annually. The pipeline represented barely 6 months of normal supply. On the demand side, multiple drivers pointed toward strength. The regional population was growing at 2.3% annually, double the national average. The demographics skewed toward the target buyer, affluent retirees, and second home purchasers. Household formation among the 55-plus age cohort was accelerating as baby boomers reached retirement. Wealth data reinforced the demand picture. The number of households in the region with net worth exceeding $2 million had grown 34% since 2010. This project's units, priced from $1.8 million to $4.2 million, targeted exactly that cohort. Broker interviews added qualitative color. 10 brokers who specialized in luxury sales were interviewed as part of the market study. All reported strong demand. Showings were up. Offers were competitive. Buyers were making decisions quickly. Several brokers mentioned receiving multiple offers on desirable listings. The macroeconomic environment was supportive. Interest rates were historically low. A 30-year mortgage could be obtained below 4%. For cash buyers, the opportunity cost of capital was minimal. Investment-grade bonds yielded under 3%. Stock market returns had been strong, inflating buyer wealth. Consumer confidence was high. Tax policy favored real estate. Mortgage interest remained deductible. Property taxes were deductible. Capital gains treatment benefited sellers. The 1031 exchange allowed deferral of taxes on investment properties. Florida had no state income tax, making it attractive for relocating retirees. The specific location offered advantages beyond the general market. The development site sat on a barrier island with limited remaining developable land. The ocean side was essentially built out. This was among the last large sites with direct ocean frontage. Scarcity created value. The neighborhood was established and desirable. High-end retail was within walking distance. Restaurants ranged from casual to Michelin-rated. Cultural institutions, a performing arts center, galleries, a sculpture garden, provided amenities. Healthcare facilities included a hospital system ranked nationally. The airport offered direct flights to major cities. Comparable buildings in the immediate area had performed well. A 22-story tower completed in 2014 sold out in 11 months. A 16-story building from 2013 sold out in 14 months. Both exceeded their initial pricing assumptions. Buyers had paid premiums for penthouse units with superior views. The development team had a track record in this market. Their previous project, completed in 2012, sold 140 units in 9 months at prices 8% above initial projections. They understood local buyer preferences. They had relationships with the broker community. They had credibility. Risk factors were acknowledged but deemed manageable. Construction risk was mitigated by the fixed-price contract and contingency reserves. Permitting risk was low, given the zoning was in place. Interest rate risk was addressed through rate locks on the construction loan. Market timing risk was the residual concern, but the long appreciation trend and favorable fundamentals suggested limited downside. Stress testing explored adverse scenarios. What if absorption took twice as long? The model showed returns would decline but remain positive. Carrying costs would increase, but revenue would still exceed total costs. What if pricing fell 5%? Returns would compress significantly, but equity would not be wiped out. What if construction costs overran by 10%? The contingency fund would absorb most of that. The remainder could be covered by the equity cushion. No scenario modeled showed total loss of equity unless both pricing fell more than 10% and absorption slowed to less than 6 units per month. That combination seemed implausible. Even during the 2008-2010 crisis, this submarket had never experienced both weak pricing and stalled absorption simultaneously. Historical data provided comfort. Over the previous 20 years, luxury condominium pricing in this market had appreciated in 16 years and declined in 4. The declines were modest except for the 2008-2010 period. Mean reversion suggested that after 7 years of appreciation, some flattening might occur, but a significant reversal appeared unlikely. The assumption looked safe because every angle of analysis supported it. Market data, demographic trends, supply constraints, economic conditions, buyer behavior, historical performance, all pointed toward stability or growth. The $950 per square foot assumption wasn't just defendable, it appeared conservative. And that confidence wasn't limited to the developers. It was shared by the lenders, the appraisers, the market consultants, the brokers, the investors. Everyone looking at the same data reached the same conclusion. Once accepted, the assumption shaped everything. The unit mix was optimized for the $950 per square foot pricing. The building was designed with 180 units ranging from 1,200 square feet to 3,800 square feet. The distribution tilted toward mid-size units, 2-bedroom and 3-bedroom layouts between 1,600 and 2,400 square feet, because market analysis showed those commanded the strongest pricing per square foot and absorbed fastest. Larger penthouses occupied the top 3 floors. These units were designed for prestige sales that would anchor the pricing for the entire building. At 3,500 to 3,800 square feet, and priced from $3.8 million to $4.2 million, they would establish the high end of the range. Their sales would create comparables that justified pricing on lower floors. The floor plates were sized to maximize efficiency. The gross-to-net ratio, sellable square footage divided by total building square footage, was engineered to 78%. That meant for every 100 square feet of building, 78 were sellable. The 22% of non-sellable area included corridors, mechanical rooms, elevator shafts, and stairwells. At 78%, the ratio was lean but functional. Higher ratios would compromise unit quality. Lower ratios would waste construction cost. Amenity decisions were calibrated to the pricing assumption. The project included 35,000 square feet of amenity space, fitness center, spa, rooftop pool, entertainment lounge, business center, guest suites, wine storage, and climate-controlled parking. Each amenity was selected based on buyer surveys indicating willingness to pay premiums for those features. The amenity budget was $8.75 million, roughly $49,000 per unit. Market research suggested that buyers at the $950 per square foot price point expected premium amenities. Without them, the building would be viewed as mid-market, and pricing would have to drop to $850 per square foot. The amenities justified the price positioning. Finish specifications were chosen to support the pricing. Flooring was European oak, not domestic hardwood. Countertops were book-matched quartzite, not granite. Appliances were integrated Miele and Sub-Zero, not standard Bosch. Plumbing fixtures were Dornbracht and Duravit, not Kohler. The millwork was custom, not semi-custom. The cost of these specifications added approximately $120 per square foot to hard costs compared to more economical alternatives. For 275,000 square feet, that was an additional $33 million. But the specifications were necessary to achieve the 950s pricing. Buyers touring units expected materials and finishes consistent with the price point. Compromise on quality would undermine pricing. The architectural design itself reflected the pricing assumption. The building was 22 stories with a contemporary aesthetic, glass and white metal panel facade, cantilevered balconies, sculptural massing. The design came from a firm known for high-end residential work. Their fee was 7% of hard costs, or $9.8 million above market for architectural services. Why pay that premium? Because design was perceived to influence saleability. A building that looked exceptional in renderings and photographs would command pricing premiums. The architecture was marketing. The developers were buying an image that justified $950 per square foot. Site planning prioritized views. The building was positioned to maximize ocean frontage for units. The tower was oriented to capture both sunrise and sunset views. Floor plans placed living areas and primary bedrooms facing the water. Secondary bedrooms faced west. No unit was without some water vista, even if partial. View hierarchy drove the internal pricing structure. Units on higher floors sold at premiums, roughly $15 per square foot per floor. Oceanfront units commanded 12% premiums over identical units facing west. Corner units with wraparound views carried 18% premiums. The pricing grid was granular, calculated to extract maximum value from view differentiation. Parking was allocated based on unit size and price. Penthouses received 3 parking spaces. 3-bedroom units received 2 spaces. Smaller units received 1 space. The parking structure was designed for 285 spaces total, 105 more than the 180 units required. The excess was to accommodate guest parking and potential future sales of standalone spaces. The marketing and sales strategy was structured around the pricing assumption. The sales center was designed as a showcase: high-end finishes, full-scale mock-ups of 3 units, virtual reality presentations, curated artwork. The sales center cost $4.2 million to build and outfit. That was justifiable only if units sold at sufficient pricing to cover the investment. The sales commission structure assumed the $950 pricing. Brokers would earn 5% on sales below $2.5 million and 4% on sales above. At projected pricing, total commissions would be approximately $12.5 million. The commission rate was competitive but not excessive, designed to motivate broker engagement without sacrificing margin. Staffing decisions reflected the assumption. The sales team consisted of 4 full-time agents plus administrative support. Their salaries and overhead totaled $1.2 million annually. That expense would continue until sellout. The assumption of 18-month absorption meant carrying sales staff for roughly 2.5 years, including construction. Total cost, $3 million. If absorption extended to 3 years, staffing costs would rise to $4.8 million. If it took 4 years, $6 million. The budget assumed fast sales at strong pricing. Slower sales or lower pricing would force either higher costs or reduced staffing, which would further slow absorption. Construction timing was planned to align with anticipated market conditions. Groundbreaking was scheduled for early 2017 with completion in mid-2019. The developers believed the market would remain strong through that period. Starting construction was a bet that by delivery, demand and pricing would support the business plan. Delaying the start to wait for more certainty would mean losing the site to another developer or facing higher construction costs from inflation. Accelerating the start risked construction issues or permitting delays. The chosen timeline balanced market risk against execution risk, predicated on the assumption that $950 per square foot would hold for at least 3 years. Pre-sale requirements were negotiated with the lender based on the pricing assumption. The bank required 30% of units to pre-sell before advancing the final tranche of the construction loan. The developers believed they could achieve that within 12 months of starting sales. The assumption: buyers would commit during construction at a 5% discount to the $950 base price. If buyers balked at $902.50 per square foot during construction, pre-sales would stall. Without hitting the 30% threshold, the final loan tranche wouldn't fund. Without that capital, construction would halt. The entire schedule, the financing structure, and the business plan depended on buyers validating the pricing assumption early. Every decision, from unit sizes to finishes to timing, was interdependent. Change one variable and others shifted. The system was optimized for a specific outcome, selling 275,000 square feet at $950 per square foot within 18 months of completion. That optimization created efficiency. It also created fragility. The project had little room to absorb deviation from the central assumption. The problem wasn't collapse, it was underperformance. Construction progressed smoothly through 2017 and into 2018. The general contractor maintained schedule. Hard costs tracked to budget. Permitting proceeded without major delays. By September 2018, the building was enclosed and interior finishes were beginning. Completion remained on track for May 2019. Sales had started in March 2017 with the opening of the sales center. Initial response was encouraging. Broker events drew strong attendance. Prospective buyers toured the models. The first sales closed in May 2017, 4 units at prices ranging from $9.25 to $9.95 per square foot. The average was $957 per square foot, slightly above the $950 assumption. By December 2017, 15 units had sold. The pace was slower than projected. The model anticipated 20 units in the first 9 months, but not alarmingly so. The sales team attributed the lag to market seasonality and the learning curve of establishing a new product. Pricing remained firm. The average across all 15 sales was $951 per square foot. Through the first quarter of 2018, 9 additional units sold. The cumulative total reached 24 units, 13.3% of inventory. The model had projected 30% pre-sold by month 18, which would be September 2018. At the current pace, the project would reach 30% by early 2019, a few months behind schedule but manageable. Then absorption slowed. In the second quarter of 2018, only 4 units sold. Third quarter produced 3 sales. Fourth quarter added 2. For the full year 2018, total sales were 9 units. By December 2018, cumulative sales stood at 33 units, 18.3% of inventory. The model had projected 54 units pre-sold by this point. The shortfall was 21 units. At 18 months before completion, the project was 39% behind the sales plan. Pricing on the recent sales had softened slightly. The 9 units sold in 2018 averaged $931 per square foot, 2% below the $950 as assumption, but within the range of expected variation. The decline wasn't dramatic, but it was directional. The developers and their advisors reviewed the performance in January 2019. The discussion focused on causes. Was the slowdown temporary or structural? Several explanations were considered. Market saturation was one hypothesis. Another luxury project 3 miles north had delivered in late 2017 and was absorbing inventory steadily. Perhaps that was drawing buyers who might otherwise have considered this project. If so, absorption would recover once that competitor sold out. Pricing resistance was another theory. Perhaps $950 per square foot was meeting hesitation. Buyers were still purchasing, but at a slower rate, suggesting the price was at the upper boundary of acceptability. Small reductions might accelerate sales without materially damaging returns. Broader market softness was a third possibility. Luxury real estate across South Florida had shown signs of deceleration in 2018. Days on market were increasing. Inventory was building. The stock market had experienced volatility in the fourth quarter. Perhaps buyers were pausing, waiting for more economic clarity. The sales team offered operational explanations. Broker engagement had been inconsistent. Marketing had been outspent by competitors. The models needed refreshing. More aggressive broker incentives might help. These were fixable issues if addressed with additional investment. The conclusion was that the slowdown was likely temporary and addressable. The remedy: increase marketing spend, enhance broker commissions, and consider modest price adjustments on select units to stimulate activity. The projection was that sales would re-accelerate in 2019 as the building neared completion and buyers could see the finished product. Internally, the developers understood the math was tightening. The construction loan required 30% pre-sales, 54 units, before the final $20 million advance would fund. At the current pace, reaching 54 sales by May 2019 completion was unlikely. The bank might grant an extension, but that would add carrying costs and delay the schedule. More concerning was the post-completion outlook. If pre-sales reached only 35% by completion, that would leave 117 units to sell. At the previously assumed 18 units per month, sellout would take 6.5 months. But if absorption remained at the recent pace, 3 units per month, sellout would take 39 months. Extended sellout meant extended carrying costs: insurance, property taxes, utilities, security, sales staff, and debt service would continue until the last unit closed. Each additional month cost approximately $285,000. 39 months instead of 7 would add $9.1 million in unbudgeted expenses. The developers did not panic. Projects rarely performed exactly to plan. Adjustments were normal. The fundamentals, location, product quality, market demographics remained strong. The issue was pacing, not viability. But the assumption was showing strain. $950 per square foot was not impossible. Recent sales proved units could transact at that level, but the volume of buyers willing to pay that price at the pace required by the business plan was not materializing. The model had assumed the market would deliver a steady stream of qualified, motivated buyers. Reality was delivering buyers, but intermittently and with price sensitivity that slowed decisions. The difference between the assumption and reality was not catastrophic. It was incremental. Incremental deviation, sustained over time, would compound into something larger. Changing the assumption would have invalidated the project. By early 2019, the developers faced a decision: revise the pricing assumption downward or hold firm and wait for the market to validate the original plan. Revising the assumption meant acknowledging that $950 per square foot was not achievable at the required pace. A new assumption, perhaps $900 per square foot, would reflect the market's demonstrated willingness to pay. Lower pricing should accelerate absorption, bringing the project closer to the sales timeline. The problem was the math. At $900 per square foot, total revenue would be $247.5 million against all-in costs of $260 million. That was a $12.5 million loss before considering carrying costs, which were increasing due to slow pre-sales. Factoring in extended sellout, the loss would expand to approximately $18 million. Equity in the project was $80 million. An $18 million loss would consume 22.5% of equity. Investors who had committed capital expecting returns would instead face write-downs. The private equity fund would have to mark its investment below cost. The family office would incur a loss. The developer's personal capital would be impaired. Beyond the financial hit, repricing would trigger contractual consequences. The construction lender had underwritten the project based on the $950 assumption. The appraisal supporting the loan used that pricing. If the developers formally adjusted their pricing strategy to $900, the bank's credit team would need to reevaluate. A reevaluation could lead to several outcomes, none favorable. The bank might require additional equity to maintain the loan-to-cost ratio. That would mean the developers and investors would need to contribute more cash, capital they did not necessarily have or want to deploy into a struggling project. Alternatively, the bank might reduce the loan size, pulling back the final $20 million advance. Without that capital, construction could not be completed. The developers would need to find replacement financing or halt the project. Worst case, the bank could declare the loan in technical default for material misrepresentation. If the pricing assumption was now acknowledged to be unachievable, the original loan application could be viewed as based on false projections. Default would accelerate all obligations and potentially force a foreclosure process. Even if the bank took no immediate action, repricing would damage credibility. Future projects would face heightened scrutiny. Lenders and investors would remember that this team missed their projections. Reputational capital built over decades would be eroded. The developers also faced agency issues with their investors. The private equity fund had marketed the project to its own investors as a moderate risk deal with projected returns in the mid-teens. If they now wrote down the investment, their own credibility with LPs would suffer. Fund managers might resist acknowledging the problem, hoping instead that time and market recovery would allow them to avoid marking losses. The family office faced similar pressures. They had invested based on trust in the developer's expertise. Admitting the project was mispriced would call that trust into question. Family principals might resist accepting losses, preferring to wait for a market turn. Psychologically, the developers were anchored to the $950 of assumption. They had spent 3 years believing in that number. It was embedded in every presentation, every model, every discussion. To abandon it was to admit error. Not just error in execution, but error in judgment. The assumption had been vetted by multiple parties. Changing it now implied that all those parties had been wrong. Organizational dynamics resisted adjustment. The development team had an incentive to project confidence. Admitting doubt could spook investors, concern the lender, and demoralize the sales team. Leadership's role was to maintain conviction and drive toward the plan. Publicly questioning the core assumption would undermine that role. The sales and marketing team resisted repricing for different reasons. They argued that lowering prices would signal desperation. Buyers would sense weakness and wait for further reductions. Brokers would lose confidence in the product. Comparable sales at the reduced pricing would damage the building's perceived value, making later units even harder to sell. The argument had logic. In luxury real estate, pricing often functioned as a signal of quality. A building priced at $900 per square foot was categorically different from one priced at $950. The lower price attracted a different buyer profile, less affluent, more price-sensitive, potentially less desirable as neighbors in a luxury community. Repricing risked degrading the product positioning. There was also the possibility that the market would improve. Economic indicators in early 2019 were mixed, but not alarming. Unemployment was low. Interest rates remained favorable. Stock markets had recovered from late 2018 volatility. Perhaps the absorption slowdown was temporary, driven by seasonal factors or short-term caution. If the team held firm, demand might return. Comparable projects provided ambiguous signals. The competing development that had delivered in 2017 was still selling, but slowly. Another project 5 miles south had recently reduced prices by 8% to clear inventory. But a third project had reportedly achieved strong sales without discounting. The data did not clearly indicate that repricing was necessary or sufficient. The developers decided to hold pricing. The rationale: the product was strong, the location was exceptional, and the market fundamentals remained supportive. Absorption was slower than projected, but sales were occurring at or near the target pricing. Patience and enhanced marketing would eventually deliver the required volume. This decision was defensible in early 2019. It was also a decision to preserve the assumption rather than adapt to observed reality. The model was not adjusted. The pricing structure was not revised. The project continued to operate as if $950 per square foot would hold. What the developers could not see was that the market had already moved. The assumption was no longer aligned with reality. But acknowledging that reality would have collapsed the entire financial structure of the project. So they chose certainty over adaptation. The assumption, once established, became locked in. By the time doubt appeared, options were already gone. The building reached substantial completion in May 2019. The certificate of occupancy was issued in June. The first residents took occupancy in July. By that point, 41 units had closed, 22.8% of inventory. The construction loan matured in August 2019. The lender had expected 30% pre-sales and a clear path to rapid sellout. Instead, they faced a project that was 23% sold, absorbing at roughly 3 units per month, with 139 units remaining. Negotiations between the developers and the bank extended through the summer. The bank wanted additional security. The developers resisted contributing more equity. The compromise: a loan extension to February 2020 at a higher interest rate, 6.5%, up from 5%, and a requirement that sellout reach 50% by the extension maturity. If not, the loan would be in technical default. The higher rate increased monthly debt service from $417,000 to $542,000, an additional $125,000 per month. Over 6 months, that added $750,000 in costs. The developers had no choice but to accept. Without the extension, the loan would default immediately and foreclosure proceedings would begin. Sales through the second half of 2019 remained slow. 19 units sold between July and December, bringing the year-end total to 60 units, 33.3% of inventory. The pace was holding at roughly 3 units per month, far below the 18 per month the model had assumed. Pricing had drifted lower. The average sale price in the second half of 2019 was $912 per square foot, 4% below the original assumption. The decline was subtle. Unit-specific factors like floor level and view complicated direct comparisons, but the trend was clear. In January 2020, the developers faced another decision. The loan would mature in 1 month. Sellout was at 33%, well short of the 50% requirement. The bank would not extend again without substantial changes. The options were limited. They could seek new financing to replace the construction loan. But new lenders would underwrite based on current performance, not original projections. With slow absorption and softening pricing, terms would be punitive. Higher rates, lower advance rates, stricter covenants. They could inject additional equity to pay down debt and reduce leverage. But the private equity fund was not willing to contribute more capital to a deal already underwater on a mark-to-market basis. The family office was reconsidering their exposure. The developer's personal resources were already committed. They could attempt a bulk sale of remaining inventory to an investor at a significant discount. Bulk buyers existed, but they typically paid 30% to 40% below retail pricing. Selling 120 units at a 35% discount would crystallize massive losses and wipe out equity entirely. They could agree to a deed in lieu of foreclosure, handing the property to the bank and walking away. That would eliminate personal liability under the guarantees, but would also mean total loss of equity and severe reputational damage. Or they could try to reduce pricing aggressively to accelerate sales and generate cash to service debt, hoping to sell out before the bank lost patience. They chose the last option. In February 2020, the developers announced a limited-time pricing adjustment of 8% across all remaining units. The new pricing averaged $874 per square foot. The reduction was presented as a strategic move to capture market share, not as distress selling. Marketing emphasized value and urgency. Broker. Commissions were increased to 6% to drive activity. The market's response was tepid. In February, 4 units sold. March added 3. By mid-March, the COVID-19 pandemic reached the United States. Sales stopped entirely as lockdowns began, and uncertainty spiked. The loan entered technical default in April 2020. The bank did not immediately foreclose, but negotiations shifted. The developers no longer had leverage. The bank was now negotiating from a position of control. At this point, the project had no good path forward. The equity was impaired. The debt was in default. Pricing was below the level needed to break even. Absorption was stalled by external circumstances beyond anyone's control. Flexibility to maneuver had been lost incrementally. Every month of slow sales reduced options. Every price cut narrowed margins. Every loan extension increased costs and tightened covenants. By the time the pandemic arrived, the project was already constrained. The initial assumption, $950 per square foot, had shaped decisions that eliminated flexibility. Unit mix, finishes, amenities, timing, capital structure, all were optimized for that pricing. Deviation from the assumption didn't just reduce returns, it invalidated the entire strategy. A project designed with more flexibility, lower cost finishes, phased construction, shorter timelines, less debt, might have absorbed the pricing pressure. But that project would have been different from inception. It would have targeted a different market segment with different returns. This project was built for $950 per square foot. When that assumption weakened, the structure could not flex. It could only break. Every discount destroyed the original logic. The 8% price reduction in February 2020 was intended to accelerate sales. Lower prices should attract more buyers. Higher volume should compensate for lower per-unit revenue. That was the theory. The reality was more complex. Luxury real estate pricing functions as much as a signal as a clearing mechanism. Price communicates positioning, quality, and exclusivity. In this market, buildings were understood to exist in tiers. Above $1,000 per square foot was ultra-luxury, $900 to $1,000 was premium, $800 to $900 was upper mid-market, below $800 was mid-market. At $950 per square foot, this building occupied the premium tier. The finishes, amenities, and location justified that positioning. Buyers in that tier were selecting among a small number of comparable buildings. The competition was limited. Differentiation was based on design, views, and reputation. At $874 per square foot, the building dropped into upper mid-market. That tier had more competition. Buyers in that range evaluated more options, weighed value more carefully, and had less brand loyalty. The reduction expanded the competitive set without necessarily expanding the buyer pool. Moreover, the price cut signaled distress to the market. Brokers understood that developers do not reduce pricing 8% across the board unless sales are underperforming. That knowledge shaped their advice to clients. Wait and see if they go lower became a common refrain. Buyers who had already closed felt betrayed. They had purchased at $950 per square foot, believing that was the market value. Now identical units were being offered for $874. Their units had lost 8% of value before they even took occupancy. Some threatened legal action. Others simply resented the developers and spoke negatively to potential buyers they encountered in the building. The pricing reduction also compressed margins for future sales. At $874 per square foot, total revenue potential fell to $240 to $235 million. Against $260 million in costs, that was a $19.65 million loss before considering extended carrying costs. Each month the building didn't sell out added $285,000 in expenses. If sellout took another 24 months, total losses would exceed $26 million. Worse, the reduction did not significantly accelerate absorption. The 4 units sold in February and 3 in March before the pandemic were not markedly better than prior months. The data suggested that pricing was not the primary constraint. Demand itself was limited. This revealed a fundamental misunderstanding embedded in the original assumption. The model had treated price and volume as reliably inversely related. Lower prices would increase volume proportionately. But luxury real estate demand is less elastic than commodity goods. The buyer pool for $2 million condominiums is finite. Reducing price from $2 million to $1.85 million does not double the number of buyers. It adds some marginal buyers, but not enough to offset the revenue loss. The developers realized too late that their product was positioned in a market segment with limited depth. At $950 per square foot, they were fishing in a small pond with few competitors. At $874, they were fishing in a larger pond but facing more competitors and catching the same number of fish. The price reduction also undermined future pricing power. Once a building establishes a sale at a certain price, that becomes a comparable. Every sale at $874 per square foot created data that appraisers would use to value future transactions. If the developers later wanted to increase pricing back toward $950, appraisers and lenders would reference the lower sales, making higher pricing difficult to justify. The strategic error was assuming pricing was the variable they could control to solve the absorption problem. In reality, Pricing reductions signaled weakness, degraded the brand, angered prior buyers, and provided insufficient volume lift to compensate. The action intended to stabilize the project accelerated its deterioration. By March 2020, the building had sold 67 units at an average of $900 per square foot. Total revenue to date, approximately $16.1 million. Remaining inventory, 113 units. If those units sold at the reduced $874 pricing, total project revenue would be $235 million, minus $260 million in costs and $8 million in incremental carrying costs. The total loss would be $27.65 million. Equity was $80 million. A $27.65 million loss meant equity investors would recover roughly $52.35 million, a 34.5% loss. For the private equity fund, this was a failed investment. For the family office, a significant impairment. For the developers, a career-defining failure. And the pandemic had not yet fully hit. The worst was still ahead. Eventually, operating costs outpaced belief. The COVID-19 pandemic shut down real estate sales in March 2020. 67 units had sold. 113 remained. Monthly burn rate, $542,000. The lender began foreclosure proceedings in May. The developers negotiated a 90-day forbearance. Sales resumed sporadically in July. Through the second half of 2020, 11 units sold. At under 2 units per month, selling the remaining 102 units would take 4.5 years. 4.5 years of carrying costs at $542,000 per month totaled $29.3 million. Combined with existing losses, total losses would exceed $56 million, wiping out equity and leaving the lender with a $24 million shortfall. In December 2020, the bank foreclosed. Personal guarantees were triggered. Equity investors lost everything. The bank cut pricing to $799 per square foot to clear inventory. By mid-2022, the last unit closed. Total sellout pricing averaged $857 per square foot. Against total costs of $273 million, the project lost $37.5 million. The building itself survived, well constructed, well located, quality finishes. But financially, complete failure. The project was designed for $950 per square foot. Reality delivered $850. That 9.8% deviation destroyed the project's economics entirely. The math turned against them through small deviations that accumulated. By the time the deviation was undeniable, the financial structure had already failed. The project had crossed a point of no return where even perfect execution could not recover embedded losses. The assumption held until it didn't. When it broke, the entire structure collapsed. No one fled. They exited quietly. The private equity fund marked the investment down incrementally. Q-Alt 2019, 15% markdown. Q2 2020, 50%. Q-Alt 2020, 0. Total loss, $48 million for a fund with $800 million in assets, a 6% NAV hit. Painful, but not fatal. The family office's $20 million loss was both financial and relational. Legal counsel reviewed documents for potential claims. None were filed, but the relationship was damaged. They withdrew from development investing for years. The developer's $12 million in personal capital was wiped out. Personal guarantees were called. Assets were liquidated. Reputational damage was severe. There was no panic. Losses were quantified. Options were evaluated. Decisions were made methodically. The lender's workout team handled foreclosure with detachment. They recovered approximately $88 million on a $100 million loan. The 12% loss was charged off against reserves. No headlines, no scandals, no investigations. The project simply failed to meet projections. The failure was rational, not criminal. Assumptions made in 2016 were reasonable given available data. Investors calculated losses, adjusted portfolios, redeployed capital elsewhere. The system absorbed the failure without disruption. Assumption-driven failures don't explode. They erode. Ownership stopped representing upside. In January 2021, the bank owned the building. 78 units sold, 102 remained. At 2 units per month absorption, clearing inventory would take 51 months, totaling $7 million in additional carry. The bank sold 60 units in bulk to an institutional investor for $50 million. They retained 42 units to sell at retail. This transaction crystallized the bank's $12 million loss. For equity investors, the bulk sale confirmed total loss. The original $80 million investment returned zero. The building had flipped from opportunity to burden. For developers, ownership had represented profit. For the bank, ongoing loss. Value was in exiting quickly to stop bleeding. The institutional buyer who purchased 60 units sold them over 3 years at $860 per square foot, yielding a 59% return. They succeeded because they bought at a price where the assumption didn't have to hold. The write-downs illustrated how assumptions shape value. At $950 per square foot, the building was worth $261 million. At $857 realized, $235.5 million. At $519 bulk pricing, $142.7 million. The physical asset was identical. Only the assumption changed. When assumptions fail, assets become liabilities because ownership cost exceeds recoverable value. Any buyer would inherit the same assumption. In late 2019, the developers engaged an investment bank to find a partner or buyer. 32 potential buyers received the package. 12 expressed interest. 8 conducted site visits. 4 submitted letters of intent ranging from $85 million to $105 million. Due diligence killed the transactions. Every buyer built models. Every buyer concluded at $950 per square foot, returns were marginal. At $900, thin. At $850, barely break even. No one would pay $105 million for low single-digit returns. The highest realistic offer was $68 million, reflecting sellout at $875 per square foot over 36 months. For developers, selling at $68 million meant realizing a $12 million loss immediately. They rejected it, hoping for market improvement. That decision was a mistake. By foreclosure, equity was worthless. But in late 2019, accepting $68 million felt like capitulation. The fundamental problem: any buyer underwrote using their own assumptions, not the developer's projections. Those assumptions, informed by observed performance, were more conservative. This created an unbridgeable gap between what developers needed to receive and what buyers were willing to pay. No, replacement buyer appeared because the underlying assumption was no longer sufficient to support a transaction at any acceptable price. Completion didn't unlock value. It sealed the outcome. The building finished in May 2019. From a construction standpoint, a success, on time, on budget, to specified quality. But completion made the financial problem worse. Before completion, the project existed in potential. Perhaps buyers were waiting to see the finished product. Completion tested that hypothesis. The answer? No surge occurred. Worse, completion triggered higher costs. Monthly carrying costs doubled from $140,000 to $285,000. Completion transformed the project from an appreciating asset to a depreciating one. Completion also eliminated optionality. After completion, the building was fixed. Only price and time remained as variables, and both worked against them. This was structural failure. The capital structure, debt plus equity sized on the $950 assumption, was incompatible with actual revenue-generating capacity. The structure was rigid, the building complete. No adjustment mechanism could realign structure with reality. Completion marked the point where the path forward narrowed to one option: sell at whatever price clears the market. Completion, the milestone supposed to unlock success, instead sealed failure. Nothing about this logic is unique. The failure resulted from a simple, plausible assumption that proved incorrect. That type of assumption underpins thousands of real estate projects currently under development. Office buildings assume future rents of $45 per square foot. Retail centers assume sales volumes of $400 per square foot. Each project is built on a number that must hold. Those assumptions are backed by the same analysis this project used: comparable transactions, demographic trends, economic forecasts. And yet assumptions fail regularly, not because of negligence, but because the future is uncertain. The development industry's response to failures is to identify specific errors, but the deeper truth is that assumption-driven failures are inevitable in a system requiring prediction of the future. Development takes years. Assumptions made at inception are tested years later. In that interval, the world changes. The system encourages optimism. Developers who underwrite conservatively lose deals to competitors assuming better outcomes. This project hit that sweet spot in 2016. The $950 assumption was aggressive but defensible, and it failed. The lesson is not that this project was uniquely flawed. The lesson is that assumption-driven systems produce failures at a predictable rate. Some percentage of projects will always encounter realities that invalidate core assumptions. Thousands of projects operating today carry the same embedded risk. The projects that fail will not be uniquely poorly conceived. They will simply be unlucky enough to encounter conditions where their core assumption proved wrong. The project didn't fail because it was wrong. It failed because it was precise. The $950 per square foot assumption was calculated from data, verified by consultants, approved by institutional committees. That precision was the problem. The entire project was optimized for $950, not for a range. That optimization eliminated margin for error. At 940s, returns compressed. At 920, returns vanished. At 900, losses began. A less precise project might have survived, but each adjustment would have reduced projected returns. The market rewards precision and optimization, until precision becomes rigidity. This is the paradox of assumption-driven development. Better analysis generates more confidence. More confidence leads to more precise structuring. More precise structure absorbs less variance. A project built on rough estimates might survive a 10% pricing miss. This project, built on sophisticated models, could not survive a 5% miss. The sophistication of the analysis created false certainty. Models are not reality. Assumptions are not facts. The failure was that the system treated the assumption as reliable enough to eliminate flexibility. Development is inherently uncertain. The question is whether the structure can absorb deviation. This project could not. It was too precise, too optimized, too dependent on one specific outcome. Most luxury projects don't collapse. They simply discover, too late, that one assumption was never guaranteed. The building stands occupied today. Physically, the project delivered exactly what was promised. Financially, it destroyed $80 million in equity and damaged careers. The difference between success and failure was 9.8%, the gap between $950 and $857 per square foot. The assumption felt safe because it was grounded in data. It felt reliable because it was tested. It felt certain because it was consensus. And it was none of those things. It was simply the best guess available at the time. This project failed because one assumption, carefully considered, thoroughly vetted, institutionally approved, turned out to be incorrect by less than 10%. That is all it took.